If you run an established B2B company, your operational objective is straightforward. You need to scale your revenue predictably, and you need to do it without bankrupting the business in the process. This chart shows the financial reality of building an internal enterprise sales team. You are committing to more than $200,000 in fixed upfront overhead, tied up during a 6 to 9 month recruitment and onboarding phase. Throughout that entire ramp-up period, you are sitting at a zero revenue baseline. That massive upfront cost assumes everything goes perfectly. When you factor in the industry average 60% turnover rate for sales reps, that initial capital investment often dissolves, forcing you back to square one to restart the hiring process. Confronted with that math, founders naturally look for a cheaper way out. They usually land on outsourced lead generation brokers. But standard lead brokers operate on volume, not revenue. They flood inboxes with generic spam and deliver unqualified meetings that look great on a monthly report. Because they aren't tied to your actual closed deals, they have zero financial accountability when those vanity metrics fail to convert into cash. Time-poor founders find themselves trapped in a lose-lose scenario. You can either risk $250,000 on an internal team that might quit, or you can slowly burn capital on a cheap Band-Aid that generates noise instead of pipeline. GroRev SalesNair functions as an integrated fractional sales department, embedding a full-stack engine directly into your existing operations. Their central proposition is highly specific. They target 2 to 3 times your investment in closed-won revenue, executed within a strict 90-day sprint. To understand how they attempt this, we have to look at their hybrid pricing model. The first component is a fixed monthly retainer. As the client, you assume the upfront financial risk to activate the partnership before any deals actually close. That retainer pays for the required execution capability from day one. You get a dedicated fractional chief revenue officer, sales development reps, and the complete outbound infrastructure needed to run the engine. The second component is a closed-won success fee. GroRev only collects this commission when a contract is signed and revenue is generated. This forces their team to prioritize actual customer acquisition, rather than just booking meetings to hit an arbitrary quota. This structure forcibly aligns their profit with yours. But the question remains, is this retainer plus commission setup a reliable way to scale, or is it just a faster way to burn cash, especially if your sales cycle takes longer than 90 days? If you've been burned by agencies before, you should be deeply skeptical here. Building theoretical pipeline is easy. Translating that pipeline into actual cash within a single fiscal quarter requires an aggressive, highly structured process. This flowchart maps the 90-day sprint. Days 1 through 14 focus on locking down your ideal customer profile. Days 15 to 30 launch multi-channel campaigns. Days 31 to 60 secure discovery meetings and demonstrations. The final 30 days secure customer closures to hit the revenue target. There's a major operational trade-off to this speed. You cannot simply sign a check and walk away. The first 2 weeks demand heavy collaboration from your internal experts to ensure the sales engine is pointed in the exact right direction. The entire 90-day model relies on strict adherence to these phases. By forcing rapid market feedback early on, GroRev ensures your monthly retainer isn't wasted on a flawed strategy.
That timeline works for a standard B2B sale. But if you sell complex enterprise solutions, your average sales cycle is likely 6 to 12 months long. Let's look at the hard truth. If your product requires extensive technical evaluations, drawn-out legal reviews, or tight security approvals, you are not going to achieve the closed-won cash target in your first 90 days. This scorecard shows how performance measurement shifts for complex sales. Instead of judging by immediate cash, ROI is calculated using your risk-adjusted qualified pipeline. You must see tangible milestones, documented access to economic buyers, active technical evaluations, and submitted commercial proposals. For enterprise sellers, this creates a clear financial trade-off. You have to be prepared to fund that fixed monthly retainer for multiple quarters before those deals finally close and the success fee triggers. The enterprise 90-day sprint focuses on establishing a mathematically sound, verifiable trajectory toward revenue that decision-makers can actually trust. This brings us to the core financial compromise you have to accept with this model. Because GroRev takes a success fee on every closed deal, you are permanently sacrificing a portion of your gross margin for the lifetime of that customer relationship. You are trading those margin points for speed to market. By outsourcing the execution, you entirely bypass the 6 to 9 months of recruiting, training, and managing that internal HR nightmare. To make this math work without destroying your profitability, your product requires a high customer lifetime value. One successful relationship must generate enough revenue to absorb the success fees, while still leaving you with a healthy net profit. Ultimately, you are surrendering a slice of equity in your deal margins, along with upfront cash, to buy execution speed and eliminate the burden of managing a sales team. To figure out if this trade-off makes sense for your specific business, we can map it out on a simple decision matrix. This chart analyzes your business based on 2 metrics. The vertical axis tracks your sales cycle length, and the horizontal axis measures your average ticket size. The perfect fit for GroRev's model sits in the top right. These are companies with high ticket offerings and short to medium sales cycles. If you land here, your deal sizes easily cover the cost of customer acquisition, and your shorter buying cycle means you'll hit that 2 to 3 times ROI target rapidly. If you sit in the bottom right quadrant, you have a high ticket size but a very long sales cycle. This is the proceed with caution profile. You can absolutely succeed with an outsourced team, but you must have the necessary cash reserves to sustain the monthly retainer while you wait for those massive deals to close. Finally, if you are on the left side of the chart with transactional, low-ticket offerings, you should avoid this model completely. Low-ticket sales simply cannot generate the necessary revenue per customer to support the overhead cost of a dedicated SDR and fractional CRO pod. GroRev SalesNair offers a structural alternative to the traditional internal sales build, prioritizing process consistency over individual hiring risks. Making this work requires your complete cooperation during their 90-day diagnostic process and the willingness to commit upfront capital before you see a return. If you have a validated high-ticket product, surrendering a fraction of your margin to gain a predictable, scaling engine is almost always cheaper than funding an internal team that fails to launch.